Welcome back to the Deep Dive, your shortcut to being instantly well-informed. Today, we are cracking open the financial blueprint and strategic roadmap of Latent Analytics Limited. Specifically, their unaudited, consolidated, and standalone financial results for Q2 FY26, that's the quarter and a half year, ended September 30, 2025.
Right. And our mission today, it's pretty crucial. We're looking beyond just the headlines. This deep dive isn't simply about the money, is it? It's about understanding the engine that drove Latent to its 11th consecutive quarter of revenue growth.
11 quarters, yeah.
We need to analyze their resilience, sure, but maybe more importantly, their strategic shifts into advanced AI, Gen AI, and agentic AI specifically, and those key data engineering partnerships.
Absolutely. For you, the listener, the goal here is clarity on where this company is actually headed.
Yeah.
We want you to grasp the core momentum, understand the strategy, centered on their Databricks partnership and global expansion.
Yeah.
And critically, understand the context behind their profitability figures. It's important.
Yeah, that PAT figure needs explaining.
Exactly. And just for background, these numbers got the board sign-off on October 24, 2025. The equity trading window opens from October 27, 2025. So let's jump right into the financial performance. 11 consecutive quarters. You said it. That consistency is really the main narrative here, isn't it?
It really is.
Looking at the consolidated top line, total operating revenue for Q2 FY26 hit for $2,575.42 million. And the growth rates, well, they confirm the momentum. 23.2% up year over year, YoY, and a strong 9.1% up quarter over quarter.
QQ. And, that sequential strength translates really well into the global currency, too. Their USD revenue reached $29.6 million in Q2 FY26. That's an 18.8% YoY growth and a solid 7.2% OQ increase.
Right.
When you maintain that kind of steady upward trajectory for, nearly 3 years, it says a lot about robust, continuous demand for their core analytics services.
Looking at the bigger picture, the half-year performance also shows serious scaling. For H1 FY26, so that's April 1 to September 30, the total operating revenue climbed to $4,935.65 million, which is, a significant step up from the $3,878.30 million recorded in the previous year's half-year period.
What's truly fascinating, though, is the quality of this longevity. It's not just about winning new deals all the time.
It's the retention.
Exactly, it's about retention. The sources reveal that a massive 76% of their current revenue comes from clients they've been serving for over 5 years.
Wow.
That depth of relationship, that's the bedrock of their financial consistency.
And when you have clients that entrenched, you inherently run into the conversation about client concentration. That remains a key dynamic, doesn't it?
It does. It absolutely does. But that stability from long-term clients also provides a kind of cushion. The Q2 FY26 figures show their top 5 clients contribute 60% of the revenue.
Still quite high.
It is. Top 10 clients account for 74% and the top 20 for 85%. But it is worth noting that the top 5 concentration actually dipped slightly. It was 62% last quarter.
Oh, okay. A slight improvement then.
A slight one, yeah. It suggests maybe small-scale diversification efforts are starting to bear some marginal fruit, letting them balance those anchor counts while maybe growing the mid-tier a bit. And that high retention, coupled with predictable spending from those top clients, that's what helps anchor their operational efficiency.
Speaking of operational efficiency, let's pivot to profitability. The adjusted EBITDA performance looks incredibly robust on the surface. It hit $580 million in Q2 FY26. That's a 23.5% YoY growth.
Strong growth there.
And crucially, the adjusted EBITDA margin remained highly consistent at 22.5% in Q2. It actually showed a marginal sequential increase.
Yeah, and margin consistency like that is, it's the financial hallmark of operational rigor, isn't it? Especially in a scaling services business. But here's the nugget we really need to pull out for you, the listener, because corporate reporting can sometimes hide crucial context.
I did notice a flag here, and this is where, we earn our keep. Looking purely at the reported profit after tax, or PAT, it actually dropped significantly quarter on quarter.
Right.
Reported PT for Q2 FY26 was $457 million, a noticeable 9.6% decline QoQ. And the basic EPS, 2.15, also declined. How? How can revenue be up, margins be stable, but profits take that kind of dip?
That raises a critical question, definitely. And the source material provides a surprisingly simple answer, actually. The previous quarter's consolidated results, so Q1 FY26, included a specific non-recurring accounting event.
Okay.
They realized a deferred tax credit of INR 48.7 million. This was related to their transition to the new corporate tax regime.
Oh, okay. So the previous quarter, Q1, was artificially boosted by a one-time tax benefit. Is that it?
Exactly, that's precisely it. So when you strip that artifact out, the underlying operational profitability is far smoother than that reported PT comparison suggests. The dip isn't really a performance issue, it's more of a standard tax regime accounting blip. That context is absolutely crucial for understanding the true trajectory of the business's financial health.
That makes perfect sense. It's a good reminder, isn't it? We always have to read the footnotes. Okay, so on the capital side then, their position looks very strong. Net cash generated from operating activities for the half year, H1 FY26, was $574.41 million.
And their overall cash position is massive, just massive. Cash and cash equivalents at the end of H1 FY26 stood at $1,272.05 million. That jumped from less than $700 million at the start of the year. So yeah, they are certainly well capitalized to fund that ambitious strategic roadmap they've laid out.
No shortage of funds for investment then.
Not at all.
All right, so let's discuss where they are actually finding this growth. The CEO commentary highlighted two specific verticals leading the charge.
Yeah, the momentum leadership belonged unquestionably to the financial services practice. It achieved remarkable 94% year-over-year growth. 94%.
Wow, that's huge.
And alongside that, a very powerful 29.9% sequential growth quarter on quarter. Following that, their CPG and retail practice grew a respectable 23% YoY. And that's a segment where the recent acquisition is really paying off.
And that leads us directly to the Decision Point acquisition, doesn't it? The sources seem to stress the successful integration and synergy derived from that move.
They do. The CFO was explicit about it. They've seen significant synergies in the CPG and retail business just 1 year after the acquisition.
So it's working.
Seems like it. And this also feeds into a crucial part of their geographic strategy, nearshoring. Decision Point's local presence is reportedly driving strong traction in nearshoring operations, getting them closer to clients in key markets.
And they're actually doubling down on that success, aren't they? We noted that on June 2nd, 2025, the company acquired an additional 10% stake in Decision Point and its subsidiaries.
Yeah, for about INR 11 million.
That signals real confidence in the acquisition's role in future growth, you'd think.
Absolutely. And what helps bring this analysis to life, or the specific client wins they mentioned in Q2 FY26, it tells you exactly the kind of complex, high-value work they're doing.
Like what? Give us an example.
Okay, so for instance, they were engaged in advanced sales forecasting, demand, and inventory planning for a global manufacturer of specialty adhesive materials. That's core operations improvement right there.
Right, deep operational stuff.
Exactly. And on the tech side, another engagement involved building robust data pipelines on Databricks, specifically to unify data for seamless analytics and machine learning for a big digital conglomerate.
Okay, so these aren't just one-off projects. These sound like foundational architecture builds that probably cement long-term relationships.
That's the goal, I imagine. Foundational work.
So this is where we look ahead then. The company isn't just resting on its 11-quarter streak. They seem to be heavily investing in a defined 3-year roadmap, centered on next-gen tech and global expansion.
That's right. They've laid out a clear plan.
Okay, let's unpack this core investment focus. It's clearly weighted toward AI and advanced data architecture.
Precisely. Their AI strategy is multifaceted. They have a core team dedicated to embedding all facets of AI into business processes, and they're investing heavily in talent upskilling to make that happen.
Makes sense.
Their key focus is driving impact through scalable Gen AI solutions, using their proprietary structure, which they call the RAISE framework.
RAISE.
Yeah, RAISE. It's basically a framework designed to make their AI implementations reliable, repeatable, and scalable across their client base. That's the idea, anyway.
Okay. And complementary to that AI focus is data engineering, right?
Correct. They're enhancing capabilities there through a specialized partnership with Databricks, focusing on innovation and best practices for building those high-performance data platforms, the very pipelines that fuel those Gen AI solutions we just talked about.
Got it. So shifting to geography now, they're prioritizing client proximity by expanding their physical footprint, targeting nearshore centers in Canada, Mexico, and the broader LATAM region, it seems.
Yeah, to strengthen client support there. And just to give you some context on that LATAM footprint, It's currently small, just 7 clients and about 25 employees.
Okay, so definitely room to grow.
Oh, yeah.
Yeah.
This is clearly an area designated for aggressive scaling. And they're also ramping up their presence in APAC, specifically with Global Capability Centers, GCCs, dedicated centers of excellence within India, across Bengaluru, Chennai, and Gurgaon, with a focused charter for rapid scaling of their talent pool there.
Hmm. It sounds like they're building a truly global delivery model,
Mm.
and that requires highly specialized talent, I imagine.
It does, and they know it. They're accelerating talent growth through L&D partnerships and in-house boot camps. They need people who can manage those raise frameworks and build on Databricks architectures.
Right. And finally, we should probably briefly touch on the external validation that seems to confirm their direction. They were recognized as a great place to work for the fourth consecutive year.
Yeah, that's good recognition. And the industry is noticing their tech focus too. They were named a leader in the Agentic AI PIMA quadrant, which, for those listening, basically means they're recognized as a top player in the competitive peer matrix for tools that automate complex tasks using AI agents.
Impressive.
And they also won the Minsky Award 2025 for most innovative use of AI in service delivery. Plus, they're strategically strengthening their leadership structure, bringing in advisory council members like Devesh Singla, who's a seasoned GCC leader, and Dr. Vandana Rana, a key advocate for responsible AI adoption. All these signals, they point toward a meticulously planned, future-proof growth strategy. #tag outro.
So what does this all mean when you boil it down? We've reviewed a business that's delivered, 11 consecutive quarters of growth, shown tremendous financial resilience, especially once we understood that crucial PT tax nuance,
Right, context is key there.
and is successfully integrating strategic acquisitions like Decision Point to boost specific verticals. Crucially, they are heavily committing R&D focus and investment into next-gen AI and data platforms like Databricks.
Yeah, the knowledge gained here, I think, is that Latent View is strategically executing a multi-pronged approach. It's quite complex. They're leveraging nearshoring and specialized acquisitions to meet geographic demand, reduce time to market, while simultaneously intensifying core investments in deep AI research via their internal centers of excellence.
It's certainly a compelling strategy for diversification and future readiness. But here's the final thought we want to leave you with, maybe the ultimate test of their execution.
Go on.
Given that 60% of their revenue still comes from just their top 5 clients.
Yeah.
Even with all the strategic expansion into Latent, the GCCs, these specialized AI services, how quickly will these new initiatives actually translate into reducing that client concentration and truly diversifying the revenue streams over, say, the next few quarters?
That's the million-dollar question, isn't it? Or maybe the billion-rupee question here. That delicate balance between supporting those large anchor clients and successfully diversifying, that will be the most fascinating metric to watch for in Q3 and Q4. Definitely. Thanks for diving deep with us today.
We'll catch you next time for the next deep dive.